At the top of the asset class stack over the 5-year period ended September 30th, 2015 was the Standard & Poor's 500 index. Of the diverse set of 13 types of assets, U.S. stocks were number 1. Also among the best performing asset classes were real estate investment trusts, both U.S. and foreign, along with high yield bonds and master limited partnerships, which are primarily made up of U.S. energy companies. At the bottom of the pack were crude oil indexes and indexes with exposure to commodities and the euro currency. The euro was down 20% in value versus the U.S. dollar over the 5 years. Commodity prices have collapsed, which has largely discredited forecasts of a commodity supercycle, a notion popularized in the press that led many pundits to predict that commodity prices would be driven higher and higher for decades due to China's insatiable demand. Oil prices, too, have plunged in the last 18 months, relegating this asset class to its lagging position. Shale drilling in the U.S. has added more than 5 million barrels a day to the global crude supply. That's been a game changer. It has knocked global supply and demand for oil far out of equilibrium, and this is unlikely to change in the years ahead. As for the bond total return indices, U.S. Treasury bonds, municipal bonds, and leveraged loans all gained 22% or 4.4% per year over the 5-year period shown in this chart. Gold in this period shot up from approximately $1,200 an ounce to $1,800 an ounce before settling in at its recent level of about $1,068 per ounce. What caused this wild ride? Gold bulls had expected the winding down of the Fed's liquidity program to trigger inflation and debase the U.S. dollar. That expectation came undone as inflation and bond yields trended much lower than investors, including the Federal Reserve, had expected. The outperformance of American stocks over 5 years is a testament to the strength of the American economy, and that is very good news. But it is also a little frustrating for diversified investors. Being diversified is, by definition, not placing your entire portfolio in any single asset class. That's because no one can be certain that the next 5 years will be as good for American stocks as the last 5 years. Owning a broad range of asset classes means you won't ever perform as well as the number 1 asset class. But it also assures your portfolio won't perform as bad as the worst asset class that you hold. Diversification and rebalancing periodically, which is the core of modern portfolio theory, provides a course of moderation. So don't lament over not putting all your money in U.S. stocks. A long-run strategy cannot be measured against short-term trends.